Welcome to the Deep Dive, brought to you by Finbot Insights. Today, we're embarking on, an in-depth exploration into the evolving world of income investing. For many retail income investors, yourself included perhaps, the pursuit of consistent cash flow from investments has become, I think it's fair to say, an increasingly complex endeavor in recent years.
That observation is certainly accurate. Traditional income sources, things like conventional dividend-paying stocks, bonds, annuities, they've really presented significant limitations in terms of their yields. And this situation, it's persisted within a low interest rate environment for, over a decade now, and projections show it continuing. It just makes the search for robust income streams more intricate than ever before.
So our mission for this deep dive is to unpack a carefully curated stack of expert sources. We've got insightful research from institutions like Vanguard and Goldman Sachs Asset Management, perspectives from specialized providers like SPYI ETFs, and the broader investment community too. We really aim to distill those crucial nuggets of knowledge, looking at the systematic construction of high-income portfolios, illuminating the innovative strategies used by active exchange-traded funds, and clarifying, importantly, the essential considerations around risk and taxation. So let's begin to unpack these vital insights for you.
Okay. So when we consider the broader investment philosophy, traditional best practices for retirement investing typically advocate for a spending strategy based on a portfolio's total return. This means a comprehensive approach, right? It encompasses dividends, interest, and capital gains, often necessitating drawing down assets through a mix of income generation and capital appreciation.
But there's a fascinating aspect of investor behavior here, one that often goes unnoticed, called mental accounting. It's this deeply ingrained cognitive bias that frequently leads investors to favor higher income producing assets. This preference, it seems to stem from a fundamental desire to fund living expenses without, the perceived need to sell appreciated shares. It fosters a greater sense of confidence and control, maybe.
Exactly. It gives that sense of security.
The crucial insight here, though, is that this natural human tendency, while comforting, can inadvertently steer investors away from strategies that might offer superior long-term total returns. It creates this tension between psychological comfort and, optimal financial outcomes.
That is precisely the challenge we often observe. Many income-focused portfolios, unfortunately, end up being constructed using a bit of an ad hoc approach. And while this method might result in higher immediate income, it frequently leads to lower overall total returns over time. Plus, you often see increased concentration risk and heightened volatility. It really raises an important question about true portfolio efficiency.
Yeah, are investors truly optimizing their outcomes? The historical data certainly underscores this challenge. Just consider the stark contrast with broad market U.S. bonds. They yielded over 13% back in 1980. Fast forward to September 2020, and that figure had plummeted to only around 2%. And the forward-looking projections, they indicate annual income for most broad market asset classes may well remain below 4% for the foreseeable future. This persistent low-yield environment clearly necessitates exploring new, more dynamic strategies.
And addressing this very challenge, a significant development in the investment landscape has been the rapid expansion of actively managed exchange-traded funds, or active ETFs. These innovative funds combine the potential benefits of active management, things like in-depth research, and the goal of outperforming a benchmark with the inherent advantages of the ETF structure itself. You get intraday trading flexibility, cost-effectiveness, and enhanced transparency.
The growth has been truly substantial. Since their debut around 2008, active ETFs surpassed, $1 trillion in assets under management by 2024. And what makes this particularly compelling is that they've grown nearly 5 times faster than their passive counterparts. So what exactly is driving this kind of explosive growth? Why are we seeing such a significant shift now?
Well, this phenomenon has been largely fueled by a combination of factors. Regulatory changes like the 2019 SEC ETF rule played a big part. It notably streamlined the process for launching new funds. Plus, investors have become increasingly sophisticated, They're demanding actively managed strategies that offer the liquidity and transparency benefits of that ETF wrapper. And within this burgeoning market, a particularly notable area of growth is options-based products, specifically derivative income and buffer funds. These innovative instruments integrate options into their investment strategies, the goal, to offer either regular income streams or a valuable measure of downside protection. Derivative income ETFs, also known as covered call or buy right strategies, are specifically designed to generate income from a portfolio of underlying assets by systematically selling call options.
Okay, so this strategy typically involves holding a diversified basket of securities and then selling call options against them. That generates these valuable premiums for the fund. The compelling appeal here, it seems, is that these funds can provide a source of yield not directly tied to traditional interest rate movements. So that offers the potential to increase and stabilize income generation while maybe simultaneously reducing overall portfolio volatility. Sounds like a sophisticated approach.
It truly is. And furthermore, historical data suggests that both full and partial covered call equity strategies have, in aggregate, demonstrated a pretty remarkable track record. They've outperformed traditional fixed income over the past 3 decades. This historical performance really underlines their potential. They could serve as a robust and compelling income alternative for those of you seeking diversified sources of yield.
Right, and this is where we uncover some truly fascinating insights. NEOS Investments has emerged as a prominent provider in this income-oriented ETF space. They're particularly known for their index-based covered call ETFs. These include SPYI, focusing on the S&P 500, QQQI, tracking the Nasdaq 100, and IWMI, concentrated on the Russell 2000 index, that's the smaller cap companies.
Yes, these funds have indeed gained significant popularity among retail income investors. SPYI alone has exceeded $1.8 billion in assets under management. They're characterized by consistent monthly distributions and attractive yields. For instance, SPYI typically offers around 12% annualized. QQQI and IWMI have yielded approximately 14–17%. That was as of May or June 2025. It's also worth noting that the management fee for these 3 equity ETFs is a uniform 0.68%.
So what truly distinguishes NEOS ETFs from perhaps others in the market is their unique, systematic, and rules-based option strategy. It's a sophisticated approach managed by professionals with, well, decades of specialized experience in option-based investing. Can you elaborate maybe on the mechanics? What makes it so distinctive?
Certainly. The core strategy primarily involves selling index call options like SPX for the S&P 500 or NDX for the Nasdaq 100. It employs what's called a laddered short call approach. Now imagine you're selling the right for someone else to buy the index from you at 2 different higher prices in the future rather than just one single price. This ladder structure helps smooth out the income stream generated from the option premiums. Historically, for SPYI, these calls were sold out of the money. That means the strike price, the price the option holder can buy the index at, was typically set about 1.5% to 4% above the current market price at the time of selling. This strategic positioning allows the fund to capture some of the underlying index's upside movement if the market appreciates, while still consistently collecting those valuable option premiums.
Okay, so what does this mean for you as an investor? Well, the strategy also dynamically adjusts its notional coverage of the portfolio. This basically means they don't sell options on all of their underlying holdings. Typically, somewhere between 75% and 90% of the portfolio's value is covered by these short call options. And this flexibility is crucial. When market volatility increases, for example, the model might choose to cover a smaller notional percentage. This lets the fund write calls even further out of the money, still generating consistent income, but retaining more potential for equity appreciation for the fund itself. It really does sound like a sophisticated balancing act.
It is precisely that. The approach carefully balances capturing those consistent option premiums with preserving the potential for a degree of equity appreciation. And this differentiates NEOS from funds that might, say, fully cap all potential upside. The strategy is meticulously designed to deliver stable monthly distributions even as the underlying market conditions and volatility levels fluctuate. It's worth mentioning, while the strategy can switch to a call spread that's selling one call and buying another further out to capture more upside, particularly in very low volatility environments, historically, market conditions have largely favored using the laddered short call strategy for SPYI.
Now, as we delve deeper into these sophisticated strategies, understanding the associated risks is absolutely paramount for any investor. A primary consideration for you with derivative income ETFs is that inherent trade-off between generating high income and achieving overall total return. By systematically selling those call options, these funds inherently limit their upside potential. What this means is that in a strong bull market, they may underperform a corresponding unhedged index, mainly because those gains are capped. How should investors really think about weighing this trade-off?
That's an essential question. While the high income can be very attractive, it's crucial for you to understand that this income comes at the cost of participating in the full, uncapped upside of a strong bull market. Another significant risk relates to the variability of distributions. While NEOS certainly aims for consistency through its rules-based strategy, it's important to acknowledge that distributions are not fixed. They can, and they do, fluctuate based on things like market volatility and the performance of the underlying options. For instance, significant declines in the underlying index could lead to lower option premiums being collected and consequently reduced distributions for investors. And while the premium received does provide some buffer against downside losses, it doesn't offer full protection if the underlying asset's price declines substantially. It's really a risk-reward dynamic that you must carefully consider.
This brings us to a really important concept, one that frequently causes confusion: return of capital, or ROC. It is absolutely crucial to understand that ROC is purely a tax classification. It's not an economic concept reflecting a loss in performance or getting your initial investment back in an economic sense. Can you maybe clarify how this impacts an investor's tax situation?
Yes, it's a critical distinction, especially for tax purposes. When distributions are classified as ROC, they aren't immediately taxed as income in that year. Instead, they effectively reduce your cost basis in the investment. This structure strategically defers taxation until you eventually sell your shares. Now, if you hold those shares for over a year and then sell for a gain against that reduced cost basis, the gain is typically subject to the favorable long-term capital gains tax rates. Should your cost basis eventually be reduced all the way down to zero through successive ROC distributions, well, then all subsequent ROC payments would be taxed as capital gains in the year received. It's also important for you as the investor to note that the portion of a distribution estimated as ROC might change throughout the year. The final official classification is provided on the annual 1099 DIV form you get from your broker. And interestingly, certain strategies like inheriting shares or even donating them to charity can potentially neutralize the long-term tax impact of ROC altogether.
Okay, so beyond the general mechanics of ROC, NEOS ETFs offer another distinct tax advantage for U.S. investors. This is because they primarily use index options, like SPX and NDX options. These specific options are classified as Section 1256 contracts by the IRS. What precisely does this classification mean for your tax burden?
This classification is highly beneficial. It means that gains from these Section 1256 contracts are taxed at a favorable blended rate. Specifically, 60% of the gain is treated as long-term capital gain, and 40% is treated as short-term capital gain. And this applies irrespective of the actual holding period of the option itself, whether you held it for days, weeks, or months. This unique structure can lead to a significantly more tax-efficient income stream compared to other income-generating ETFs that might classify their distributions solely as ordinary income, which, as you know, can be taxed at much higher rates for many investors. It's a subtle but potentially powerful advantage.
Now, beyond their equity-focused offerings, NEOS also provides ETFs designed for fixed income and even cash alternatives, catering to a broader spectrum of risk profiles. Let's consider BNDI, their Enhanced Income Aggregate Bond ETF. This fund strategically uses SPX index put spreads to generate additional income. How did that strategy function, and what's it aiming to provide for an investor maybe looking for stability?
Right. BNDI aims to add an extra, say, 2% to 2.5% yield over a core aggregate bond portfolio. And critically, it tries to achieve this without significantly increasing the portfolio's overall volatility. The use of put spreads, selling a put, and buying another further out of the money on a broad index like the SPX allows the fund to collect premiums, enhancing yield, while maintaining that focus on stability inherent in bonds. Complementing this, there's CSHI, the Enhanced Income 1-3-month T-bill ETF. This represents an ultra-short duration portfolio, really designed for parking cash. It employs a similar put spread strategy, but with a key difference. The options are rolled weekly, and they're positioned further out of the money. This meticulous approach aims to maintain very low volatility while striving to provide an additional 1% to 1.5% yield over traditional T-bill yields. It offers a potentially compelling alternative for your short-term cash management needs.
Looking ahead, the dynamic nature of market conditions and yields, it undeniably necessitates a time-varying approach to portfolio construction. Recalibration of investment strategies becomes crucial when material changes to capital market expectations occur. We anticipate the market for active ETFs will continue its significant expansion, probably with an increasing focus on solutions-oriented funds addressing specific investor needs. Given this landscape, what's NEOS's strategic positioning? How do they see their future unfolding?
Well, as interest rates potentially decline sometime in the future, the search for robust income streams might intensify again. That would likely make these types of products increasingly attractive to an even wider investor base. NEOS, for its part, is actively exploring future product developments. That includes potentially leveraged versions of their ETFs. This strategic direction would aim to cater to an even broader spectrum of investor needs, acknowledging that such products could offer enhanced yields and returns, perhaps for specific asset allocations within a diversified portfolio. Currently, the firm focuses mainly on the U.S. market, but it does recognize the growing international options market as a significant potential area for future expansion. I think a core differentiator for NEOS, and really its competitive edge, lies in their deep specialization in options management, their systematic, rules-based approach, and, importantly, their unwavering commitment to transparency and direct engagement with clients.
That specialized focus really ensures their strategies aren't just ad hoc, but rather meticulously designed and executed, drawing on decades of experience. It offers a precise approach to income generation in what is often a complex market. So, we have now thoroughly explored the modern landscape of high-income investing. We've emphasized the strategic role active ETFs and sophisticated option strategies can play in generating consistent cash flow. Understanding the nuances from layered call options to their favorable tax treatment is indeed essential knowledge for any retail income investor like yourself. This deep dive clearly underscores that while the pursuit of income certainly requires careful consideration of risks and rewards, innovative and precise solutions are increasingly available to help you navigate these ever-evolving market dynamics.
So maybe consider this. How will you refine your own income strategy to align most effectively with your financial goals in this increasingly dynamic market environment? The opportunity to optimize your portfolio's income potential has arguably never been more diverse.
We trust this Finbot Insights deep dive has been informative and valuable for you. Please do remember to like this video and subscribe to our channel for more detailed explorations into the world of finance and investing.